Welcome to Built to Finish. I'm your host, Stephen Pivnik. Join me each week as we explore the journeys of audacious goal setters. This includes experienced founders, CEOs, and entrepreneurs sharing pivotal moments that propel their success. We'll also be talking with endurance athletes who push the limits of physical and mental ability. This show is brought to you by Acresis, offering tailored, high-impact advisory services to help founders get to their finish line with a strategic acquisition or majority investor recapitalization. Let's get started. Welcome back to another episode of Built to Finish. I'm excited to be talking with today's guest. His impressive career spans a range of roles and accomplishments that have shaped the business landscape. He has over 25 years of experience in financial accounting, auditing, and management advisory services. He is a former partner in the Baker Tilly digital practice, where he led the finance as a service team, providing invaluable expertise in business process outsourcing and financial consulting. He is also a certified public accountant and a proud graduate of Rice University. Marcus Wagner, welcome to the show.
Thank you, Stephen. It's good to be with you.
No, it's great to have you here. So I always start with the end in mind in terms of exit planning and exit strategy. You made some really great decisions early on that led to your company's success in the long run. Can you elaborate on what some of those decisions were?
Yeah, absolutely. We founded the company about a little more than a decade before we sold it. And from day one, the purpose was to start a company that we could sell, that we could monetize. It was not, a hobby business. It wasn't something that was meant to be a lifestyle business. And so as we were doing that, and I don't mean to imply that we knew everything up front, but we tried to imagine what would be attractive as a business that a company would want to buy. What are the types of revenue streams that would be the most valuable? What is the nature of the contracts with our customers that would make them the most sticky? Recurring revenue was kind of the main goal from day one. So although we made a lot of pivots and a lot of changes and we learned a lot of things throughout the course of that decade, that was something that never really changed, was to build a recurring revenue business that would be as valuable as possible for our shareholders.
So that was a great strategy. So you basically started the company with the end in mind, and all of your decisions, throughout the years had that end in mind.
Absolutely. Yeah. I mean, I think if as a founder, as a CEO, as a president of a business, if you're always thinking about, what decisions am I going to make today that are going to make this business the most attractive, 3 years from now, 5 years from now, 10 years from now, whatever your time horizon is, and then be willing to listen to advice along the way from people who have done that before. I think that was one of the key, sort of fundamental aspects of what we were doing.
Sure. No, definitely kudos for taking that approach, because it resulted in an optimal outcome for you and the rest of the stakeholders, right?
Absolutely. Yeah. And for me, I think for most founders, and you could probably relate to this too, Stephen, when you found a business, you're emotionally invested in it, right? It's your baby, if you will. It's something that's deeply, probably personal to you. You probably, like I did, took a very large risk with your personal finances to bootstrap the business in the early days. We did not have outside capital. And so one of the first decisions that I made that was difficult was to allow others in, to allow investors into the capital stack. And those first investors that we brought in, we worked with a company called Acresis, who I know you and I both have worked with. And I don't want to mislead and say they were investors. They really came in as advisors. But the nature of our arrangement with them included both a work fee where we paid them a certain amount of money per year, and also a success fee, which looks a lot like equity. They were going to get a percentage of whatever our enterprise value was at the end of the day. And that was very difficult for me, but I'm really glad that I made that decision, because what the door that opened up was access to a bunch of people who had founded businesses, grown businesses, sold businesses multiple times. And so I wasn't in it alone.
Hmm.
It enabled me to, have kind of a 411, 911, on my Rolodex, to calling my advisors at Accresis and say, hey, I've got this issue. What's the best way for me to approach that? And they too helped me think about, how is this business going to look when it's ultimately up for sale? And from the time we hired them to the time we sold the business was about, I think, 6 years. So there were a lot of great decisions that we made along the way with their advice.
Yeah, that's definitely on the longer end of an Accresis engagement, but I personally can't speak highly enough about them and help that they offered me, similar to the help they offered you in scaling and selling my business. And hey, I like them so much, I actually joined them. So I'm really enjoying, paying it forward in the entrepreneurial community and helping founders that were, in my shoes 10 years ago, similar to the situation you were in. So when it came time to actually execute on the exit strategy, how did you go about identifying potential buyers?
So, I'd say there were sort of two phases to our exit. The first phase was, I guess I would call it an exploratory phase, which started a couple of years before we began the process really in earnest, before we began phase two. The exploratory phase consisted of, through Accresis and other people in our network, just going out and meeting with potential investors, potential buyers. And I would say during that time, most of the companies we met with were potential financial sponsors, so private equity firms
Hmm.
for the most part. And that was what we always thought would be our outcome, was some kind of a private equity transaction, whether it was, a minority investment or a majority recap or something like that. And during that exploratory phase, we didn't really know what we didn't know. We didn't know who was out there. We didn't know how we looked to those prospective buyers. So, we had a pitch book and we had a message and a value proposition, and we were just kind of testing the waters.
Hmm.
And I would say, on the one hand, phase one was very important because the more of those conversations you have, the more educated you get on the types of questions you're hearing, the more educated you get on who's buying what you're selling. I mean, I think you have been in the same situation I have, where you're pitching your company and you have a strong belief that you will be successful and that you have been successful and that you've built something beautiful. And people come to the table with a lot of skepticism, and so hearing the skepticism and learning some of the hills that you have to climb to get people over those initial hesitations was very helpful. On the other hand, you have to move out of phase one at some point. You have to move out of that exploratory phase. And that's what we did in, I guess, September of 2020, when our board approved a process for going out and doing a major capital raise or potential trade sale. And in that phase, we, instead of being in an exploratory mode and sort of letting the wind blow us whichever direction it blew us, we said, look, we're going to start a process that we're going to control. And I think that was one of the things that was really, really important to our success. Was we said, we're going to hire an investment bank. We're going to have that investment bank set up a very formal process,
Hmm.
take us through that so that we control our destiny. And we're not, meeting other people's deadlines, but we're setting the deadlines for, okay, I need an indication of interest at this point, need a letter of intent by this deadline, et cetera. So phase two was very much, we were in the driver's seat. We had a very formal process. Even starting with hiring the investment bank, we ran a very detailed selection process where I think we started with like 20 investment banks.
Oh
And
wow, 20? That's a really
yeah,
high number.
well, and Accresis was really key in that they interviewed and pre-screened a lot of those investment banks without me even talking to them. And then we narrowed it down to six. We ran a process. We selected an investment bank that we went with, and then at the beginning of 2021, we signed our contract with the investment bankers, and off we went. So, phase two was all about formality. It was all about us taking control, not sort of putting ourselves out there and saying, who's interested, but running a very intentional process with a lot of science behind it, quite frankly.
Sure. I mean, and that's exactly what investment bankers do. So your phase one, your exploratory phase, you did that completely on your own without the help of an investment banker.
We did have the help of a crisis. And
Okay.
so, in our business, we had customers all over the country, and it's certainly concentrations of customers in certain places. And so one of the places was New York City. And a lot of times I would just go to New York and set up meetings with customers, check in on them. And whenever I was there, we would make sure that we met with, some of the private equity firms that were there. I attended, again, Accresis has a number of events that they do throughout the year with founders and networking and things like that. And so we always made sure that if I was coming to an event or if I happened to be in town for some reason, that, we would try and get in front of two or three companies, private equity firms, or maybe even prospective trade sale type buyers. And so when we went out with our book with the investment bankers, we were already a somewhat known quantity.
Okay.
In that, we had, people had heard of us, people had seen our projections, we were, I guess, a little bit more savvy in terms of how we presented ourselves and how we conducted those conversations, because we'd been practicing it for a couple of years, I would say.
It sounds like with your exploratory phase, because you were going out there, you weren't overly concerned about confidentiality and the news leaking out that your company is potentially for sale, or were you?
No, we really weren't. We weren't presenting ourselves as, "Hey, make us an offer." We're for sale. We didn't want that, obviously, to become the word on the street. But we said, "Hey, we just want to tell you about our company. At some point, we'll be looking to raise some money." And that was typically the pitch, right? It wasn't, "Hey, well,
Okay.
make me an offer. I'm looking to get out." I don't know if I can still say it now, but I was at the time a relatively young guy. And one of the first questions that people ask is, "What are your plans as a founder? Do you plan to stick around, or are you looking to just ride off into the sunset?" And so, in that regard, we kept our cards pretty close to the vest, right? We were saying, "Hey, we're a high growth company. We're not going anywhere. We've got a long runway ahead of us. I myself am not going anywhere. I'm looking to just keep doubling down on this incredible opportunity, but we need capital in order to make the investments that we need in order to grow." And that was the pitch. And so it was very open ended in terms of timeline. It was very open ended in terms of, "Hey, how much are you looking to raise?" Or, "Are you looking for a minority stake or majority control? Or are you looking to sell the business?" We kept all of those doors open, if you will. And so because of that, we didn't feel like we were really sharing anything, out of school, if you will.
Sure, I get it. So because you were operating with the end in mind, I'm assuming you had a leadership team in place that had exit experience already, and how much did that help your process?
That's a great question. At various stages in our history, we had people in the chairs that they were sitting in that had some exit experience. For the most part, until the end, where we were in phase two and we'd hired the investment bankers, the majority of our management team had not gone through an exit. However, one thing I was accused of frequently throughout the history of Act Two was overhiring. And what that means is, going out, and if you say you need a VP of sales or a chief revenue officer or a chief delivery officer, and let's face it, we weren't a giant company, but I would go out and try to hire the most qualified person, not for that day and that year, but potentially for the exit, so that, they were ready and prepared. And that really paid dividends as well. Now, I will say this, and this is an overarching comment about how we ran the business. We were not looking to maximize EBITDA. We were really always positioned as a growth company. And so it was always about revenue growth. And so what that meant was, we would make investments, for the future. We would make investments for growth. And so, if I needed to hire a CFO who was, a really high powered CFO, and was going to cost me, a couple $100,000, even though I didn't need that person in that moment, I would probably go ahead and pull the trigger. And so when we got to the end and we put ourselves out for sale, the investment bankers told me, "Look, this process is probably going to demand all of your time, Marcus, as the CEO. So
Mhm.
you better have a management team who can keep the lights on and keep the business running and keep hitting your numbers. And that's exactly what I said to my team. I said, look, we're starting this process. I got total buy-in from them at the beginning that, this is what we're going to do. They all had some form of an equity stake in the company. But I said, my goal is to try to keep you as far away from this as possible so that you're not distracted. We have a budget that we're going to pursue throughout this year. And we want to make sure we hit those numbers, because as soon as we're out on the street and people are starting to see, our data room, they're going to want to see, hey, how are you doing against your current year budget? And so I had the luxury of being able to step away from the business and focus on the sale process while the rest of the management team was able to run the business. And we did, I will say this, long answer to your question, but last thing I'll say is we did go out and hire a very seasoned CFO, because I knew that was going to be the number 2 person on the management team that was going to be spending the most time dealing with the bankers and dealing with the private equity firms. And that CFO he had been through multiple exits. He'd been a CEO in the past. He'd been a chief operating officer. And that was huge, because when the bankers asked for a certain piece of information or they put their due diligence request list out there, he knew exactly what they were asking for and how to go get it and where to go get it. So people accused me of over hiring, but I felt good about it. And I think it was a good plan.
Yeah, you brought up a lot of different great pieces of advice. One is over clubbing positions. That's a term I like to use. Over club positions whenever you possibly can. Sometimes really great players become prohibitively expensive. But if you look around, you can definitely find folks for the next level of your growth versus the level that you're at right now, and that's going to pay dividends. The other thing that I completely agree with is the single most important member on that team during the due diligence and sales process is going to be the CFO. And it's incredibly, ideally other members have exit experience as well, but without an super experienced CFO, the results aren't going to be, or the process is not going to be as smooth and as optimal as it possibly can.
Absolutely. I still remember getting that first due diligence list. And it was odd to me because, I come from a finance background. I was at PwC and I was an auditor and, did financial consulting and all that kind of stuff in my past. So I knew what due diligence meant. And to me, that was a list that you got from, a potential investor or a potential buyer. But our investment bankers, and this is really kudos to them, they gave us the most robust due diligence list that you can imagine. And it was hundreds and hundreds of lines on an Excel spreadsheet, broken down into legal and board minutes and governance and financials and operational stuff and sales information. And so the CFO that we had, his goal was to keep that as quiet and away from me as possible, because the less I heard about that, the more I knew that it was just getting done and it was getting handled. And every now and then I would get called in to help with that. And my eyes would just kind of roll back in my head at the amount of detail that was being handled there. And so the last thing you want to do as a founder is get sucked into that and get distracted, because my job was, I guess, to kind of be the swan on the surface of the lake, right? And look pretty while the legs below were pedaling as fast as they could. So kind of the way I think about it.
No, that's a really good analogy. So it sounds like with your investment banker's assistant, you already had the majority of your data room ready to go, so that when the information requests came in, you literally just gave them access to the data room.
That's right. I think that would be another piece of advice I would give, listeners or future founders is act like you're in the process way before you're in the process. Yeah, I used to work with public companies all the time, and companies that were planning to go public, and they always use the phrase, we're going to act like we're public today, even though we're not going public until 2 years from now. And that's the same thing when you're selling a private company. And what does that mean? That means, before we even had investors, here's an example. Before we even had real investors, we started having board meetings. We didn't have a board. The board meetings were myself and my CFO and a couple of the guys from the Accresis team that advised us. But they taught us how to conduct a board meeting, how to set the agenda, the types of things that need to be discussed, the formality that is associated with having a board of directors, keeping minutes. So we did those things before we even had a board. We had a board, right? And this, by the same token, before we even had a data room, we put together what we thought a data room would look like. We created the file structure and the folders, and we started gathering the things. And you can't do that soon enough, because what you find when you start trying to put a data room together is you're missing things. You think you have everything, but oh, gee, we probably should have documented that. Or, oh, where's our operating agreement? Oh, we don't have the latest version. Or maybe we need to update the operating agreement because there's some things about it that we feel like need to be cleaned up before somebody takes a look at it. So that level of hygiene really helped us quite a bit.
I love that advice. I use the term always be closing. The most of the time, always be closing in the business context means always be closing your next deal. I refer to ABC as always be closing your books, right? Have the diligence in place and the discipline for the books to be closed as quickly as possible when the month and quarter ends. This way, when investors or acquirers are requesting it, you can quickly raise their perception of you if you hand this stuff over really quickly and professionally.
That's exactly right. I love the ABC analogy and the reference to Glenn Gehrig and Glenn Ross.
Yeah, exactly.
Yeah, I mean, I think one thing that founders may not realize, and I certainly learned this through my process, is that it's all about enterprise value, right? You're trying to maximize your enterprise value, which at the end of the day is one number. Now there's deal terms and things like that you need to worry about too. But if you're trying to maximize enterprise value, there are a number of things that can increase your enterprise value. And by the same token, a number of things that can destroy enterprise value. And one of them is when a potential buyer asks you a question, if you can just pull it out of your back pocket and have it ready, and that provides a lot of confidence in that buyer that they're not going to have surprises and that what you're doing. Now, the flip side is if you're scrambling and you can't find it, and they have to ask for it 2 or 3 times, or God forbid they ask for it multiple times and you give them a different answer, that is not good, and that will destroy enterprise value. In my prior life as a consultant, I saw companies' entire deals fall through at the last minute because of some surprise. Maybe they didn't have their sales tax figured out, and as part of the due diligence, somebody came in and determined they had a huge sales tax liability. You just don't want surprises. You want to come across looking organized. You want to be able to be very responsive to questions. You want the information you provide to be accurate, and it just needs to look as effortless and flawless as possible. And in order to do that, a lot of work is required up front to get all those things ready.
I thought you just brought back a really bad memory. We thought we had all of our ducks in a row, and in the 11th hour, there was a whole bunch of sales and use tax issues that were uncovered. And I went back to my accounting firm asking them, and we had audited financial statements from one of the larger accounting firms. And I said, how can you possibly have allowed this to happen? And they said, well, we knew there was a sales and use tax issue, but we didn't feel it was material enough to make your audited financial statements. I'm like, it totaled to a 7-figure number. How could that be immaterial? We weren't, we weren't that big we're a larger company, but we weren't that big of a company for a 7-figure number to not be considered material. And that resulted in a larger holdback by the acquirer, which we eventually got back, but it was unnecessary stress in the final hours of the deal.
Well, I'm sorry to bring up a bad memory for you, but hey, that's the purpose of this podcast, right? Is
Exactly.
have people learn from our mistakes, and so let's get some value out of that for them. I think what this brings up in my mind is a concept called sell-side due diligence. What is sell-side due diligence? Well, again, like I mentioned earlier, early in my career, I always heard of the word due diligence as requests from the buyer for information. It doesn't have to be that way. That's what's called buy-side due diligence.
Mm-hmm.
Sell-side due diligence is when you conduct due diligence internally on your own company. An example of that, and we did this because we had heard about these nightmares, was we hired a sales tax specialty firm to come in and do a sales tax due diligence on us. And this was before we even started our process with the investment bankers. And they came in and they did a nexus study to determine where we had nexus, which basically just means where should you be paying or filing sales tax, in which jurisdictions are you doing business. And they came back and they identified some exposure. Luckily for us, it was only $200,000 or $300,000, although at the time that sure felt like a lot of money.
Sure.
But they recommended that we file voluntary disclosure agreements with those jurisdictions, which means basically contacting formally the sales tax authorities and saying, hey, mea culpa, we've been doing business in your jurisdiction. We want to come clean and pay whatever taxes and penalties and interest we owe. And what that does is two things. Number one, it allows you to document that you've done that and that somebody has already done the due diligence that the future buyer is going to do. And they can just look at it and say, oh, there's something we don't have to do because they've already done it. And number two, it clears out the liability, so it's off your books, and it starts the statute of limitations to run. Because what happens, a lot of people don't know this, if you don't file in a jurisdiction ever, then there is no statute of limitations. If that jurisdiction comes to you and says you owe $1 million of sales tax, they can come at you 10, 15, 20 years from now.
I did not know that, so I learned something here.
But if you file, let's say you file and on a certain date, and maybe you file incorrectly, but the statute of limitations might be 3 years or 5 years in that jurisdiction. So as long as that time runs out, those errors can no longer be recovered unless you commit fraud or something like that. So anyway, probably more detail than you wanted to know, but that's an example of sell-side due diligence that we conducted, where we identified the problem, we cleaned it up, so that when they asked for it, we said, here's our nexus study, here are our voluntary disclosure agreements with all the different states and counties and cities in which we do business. And again, no surprises, had the answer right at the tip of our fingers, and we moved on down the road.
No, that's perfect. I mean, state and local taxes are a big deal when you're operating a company. It is a humongous deal when you're selling your company, especially if you're doing an asset sale. I'm sorry, especially when you're doing a stock sale, because all of those liabilities are going to get transferred over, and the acquirer is going to perform an incredibly in-depth study on that.
Yeah, no doubt.
So sounds like you definitely had most of your ducks in a row, and in preparation for the exit. Were there any surprises that came out of the process?
I will say, I know it sounds crazy, but I think the answer is no. I've told people before that I really loved founding a company. I loved seeing it grow. I loved running it. I loved, I got, as a founder early on, you're involved in almost all the sales cycles, and then you're involved in the bigger ones as the company grows. And I enjoyed all of the aspects of being the founder and the CEO of my company. But what I enjoyed the most was that roughly 1 year that I spent just almost full time prepping the company for sale, and then ultimately selling it. If you do it right as a founder, it doesn't have to be this scary process. What it can be is the culmination of your life's work, right? I mean, we put everything we have into these businesses, whether it's our cash, whether it's our time, our worry, our stress. And so if you do it right, that final lap that you take as you're kind of running to the finish line can be a very enjoyable process. And it really was for me. Now, the one surprise I will say was, I mentioned this earlier, we thought from day one that we would be doing a private equity type transaction. And in fact, when we started the process, what we put in our pitch book was, we're looking for a minority investment from a private equity firm to just raise some growth capital and allow some of the founders like myself and some of the other folks that had taken risk to take some chips off the table. As the process evolved, we moved from minority to majority recap. We moved ultimately from just talking to financial sponsors to also talking to strategic buyers that were interested in an outright trade sale. And at the end of the day, we sold our company to one of the top 10 largest accounting firms, and we did 100% trade sale, all cash. And that is not what I expected. That came out of left field for me, but at the end of the day, that ended up being the most favorable outcome for myself and my investors.
That's amazing. So that's a very common thread. The majority of the people I speak with, they always have a preference, right? A financial sponsor or a strategic, and they always. I have found that most of the time the transaction is not what they were expecting.
It's not what you're expecting. And so, the lesson that taught me was, and this is one of the things that Croesus recommended, was if you're selecting an investment banker, and by the way, not every company qualifies to work with an investment banker, so we can talk about that a little bit if you want. But if you're selecting an investment banker, you need to have a criteria for the type of investment banker that you're planning to work with.
Mhm.
And one of the criteria was we wanted the one that would give us exposure to both financial investors, i.e., private equity firms, and strategic buyers. And we also wanted a private equity firm that would give us access to both domestic and international markets. And so, in hindsight, and I'm not even sure I knew what all of that meant when Accresis was taking me through it, but we selected the investment bank that we did, and they gave us, I think our book went out to 255 parties who were interested, who signed NDAs and took a look at us, which tells you, the breadth of exposure that the investment banks are able to give you.
Mhm.
And ultimately, we had, less than 10 letters of intent or offers. And the best offer we had was from a strategic buyer. So glad that we chose the investment bank that we did and the criteria that we used to select them.
No, interesting the way these processes pan out. So, because you ended up going into due diligence with a strategic acquirer, how was the integration planning? And like, what advice would you offer founders that are going through integration planning with the strategic acquisition?
When we had signed, I guess, the letter of intent and we had a list of conditions to close, and there were a lot of things that had to get done, but both parties basically had said this deal is going to happen. They sent us their list of the integration team, and the investment banker said, "Hey, by the way, the integration team has got more people on it than your company has employees. So get ready. If you do that's a whole other dimension, right? Of uh, planning when you're doing a strategic trade sale, because what you're talking about is integrating your company into another company, and that involves a lot of complexities. So I will say that that was not a work stream that I anticipated, because again, we were planning to sell to a private equity firm, and this company that we sold to, it was a top 10 public accounting firm, a CPA advisory firm. They I think did something like 6 acquisitions in that fourth quarter in which they bought us. We were one of them.
You were one of 6 in a single quarter.
In a single quarter, they were
Wow.
very acquisitive. And so, they were distracted. Their people, even though they had a huge team, they were burning the midnight oil, and they were trying to close other deals that were ahead of us. There were deals that we were ahead of that they were trying to pursue. And I think that aspect is going to be true of, a strategic buyer and a private equity firm. Most private equity firms have a pipeline of investments that they're trying to make. And one of the things that I remember about that time period, this was October of 2021, which anybody who knows the markets knows that was basically the absolute peak of deal making. There was so much private equity money in the market, but there was a lot of strategic buyer money out there chasing acquisitions. And so attention span became a very scarce resource. And in fact, one of the private equity firms that we had, and quite frankly, the one I thought we were going to go with, they had so much money they were trying to place, and they ended up seeing a deal that had a check size that was about 5 times bigger than us. And they basically said, we're going to put you on a hard pause, which means you're done. And the reason they did that was they realized they could deploy 5 times more money with the same level of effort, because you still have to go through all the due diligence and the negotiation and everything else. So, that deal went completely away because of competition for attention span. Um, on our strategic buyer side, I had to pay a lot of attention to that integration planning, because it was going to affect all my employees, right? If we didn't do a good job with the integration planning, then we might have a lot of high voluntary attrition. We might lose customers. Our competitors might get wind of the deal and try to take advantage of us being distracted and try and go after our customers or our employees. So it got done, and I would say it got done probably about as well as it could have. But I will also say that was a very messy and very hectic period of time as we were talking about integrating into a business. I mean, we were roughly a $30 million revenue business integrating into a $1.5 billion business.
Wow.
So getting people's attention was pretty hard to do. And, we're just little gnat flying around as they were trying to conduct their acquisition strategy.
So how was it for you personally, right? Coming from a founder, CEO position and being in charge of everything to becoming a part of, like you said, a significantly larger organization. What was that transition like for you?
It was interesting, if you're used to, I've talked to so many founders, maybe you can relate to this, Stephen, that say, after they're 3 or 4 years into running their own business, that they're basically unemployable because, you're your own boss. There's nobody above you unless you have a board of directors. But really, in a private company, the founder or CEO can make whatever decisions he or she wants to make, right or wrong. And going from that to having, I mean, I told people I was my own boss, and now my boss has a boss who has a boss. Uh, and so that was difficult. That was very difficult. What was important for me was not me, but it was my employees, the rest of my team. I was very concerned. When you announce a deal like this, every CEO has to say to their employees, "This is going to be great for you." You have to say that.
Right.
It's very important that you believe that, because if you're saying it and you don't believe it, that's not a good place to be. And I can happily report that even to this day, and I guess we're almost 4 years past my deal, that almost all of those employees are still there.
That's
Uh,
fantastic.
so kudos to our buyer, who, uh, because that retention really goes to their credit. They had a great culture. They had a great compensation and benefits. They had a great strategy, and our employees, when they first heard about it, they were taken aback and they were worried. And, a couple of them left because they thought this was going to not be good for them. Those two people ended up coming back
Really.
uh, because they realized the grass truly isn't greener on the other side. And our buyer basically put their money where their mouth was, and they delivered on their promises. So I guess I would say advice to founders is, if you're going to sell to a strategic, and you plan to, well, I guess whether you plan to stick around or not, if you care about the people that are planning to stick around, you really need to get a sense for the culture of the company. You need to get a sense for their strategy and where they're planning to take the business. Are they planning to break it up and, integrate 5, 10 pieces of your business into different parts of their business? Are they planning to invest in the business going forward like you would? Are they bringing perhaps more resources to the table that will allow the business to thrive even better than you could have on your own power? All of those things are important, especially if you plan to stick around, because uh, life can be very unfun if you're working for a company that you don't like.
Wow, that's a great way to end the show. Life can be really unfun if you're acquired by a company that you don't like. I can talk about that specific topic for hours, but we're going to end it here. Marcus, thank you very much for giving the amount of advice that you've offered here to fellow founders. There's a ton of great advice and lessons learned that you shared. So I really appreciate you being a guest on the show today.
I'm honored to have been invited, Stephen. It's great to talk about it with you, and the best of luck with your endeavors going forward.
No, I appreciate it. Thank you so much. Thank you to all the listeners and watchers for tuning in to another episode of Built to Finish. If you've enjoyed this show, please like and subscribe. If you found any of the stories and advice and lessons learned shared by Marcus valuable to anybody else, please do forward a link to this episode to them. Thank you very much again for tuning in. Take care. That's a wrap for this episode of Built to Finish. Thank you for tuning in. For show notes and more details, head over to podcast.stephenpivnik.com. Special thank you to our sponsor, Accresis, offering tailored, high-impact advisory services to help founders get to their finish line with a strategic acquisition or majority investor recapitalization. Catch you next week.